All right, and we are live. Yeah, welcome, guys. Welcome to this webinar. We'll discuss if 2024 will actually be the year for Cosmos and what insights we can learn from the dYdX Foundation and Pantera Capital around the recent launch of the dYdX V4 chain, which utilizes the Cosmos SDK. We'll also take a look at where things are currently at. Talk a little bit about MEV and what all this means for institutions. So I'd say let's get us started with a round of introductions. I'll kick it off. My name is Yannick, and I'll be moderating this discussion today on behalf of Chorus One. We're one of the largest enterprise-grade node operators globally. Currently run validators for I think about 45 different networks. We also have a very strong research team that heavily focuses on MEV and actually recently published a report about this topic for dYdX as well. And lastly, we also invest via our venture fund, Chorus Ventures, which is an early stage fund and mostly focused on infrastructure projects. That's us. And yeah, I think now next, maybe we start with you, David, and then you can hand it off to Karan and Cosmo after.
Sure. Hey, everyone. Excited to be here. My name is David Gojal. I'm the VP of Strategy and Operations at dYdX Foundation. dYdX Foundation is a Switzerland-based nonprofit. Our mission is to grow the dYdX protocol by enabling communities, developers, and decentralized governance. I'm really excited to be here.
Sure, I can go next. Thanks, David. Yannick. I'm Karan Ambavani. I'm leading the India and the Middle East market for dYdX Foundation. So I'm part of the GTM team. And as David said, of course, the goal for the foundation is to grow the community around dYdX protocol. Excited to talk about Cosmos. I've been building in the Cosmos space prior to joining dYdX as well. So yeah, over to you, Cosmo.
Hey, hi everyone. Thanks for having me. My name is Cosmo Jiang. I'm portfolio manager responsible for all our liquid token strategies here at Pantera. Pantera is the first institutional investment firm focused exclusively on blockchain, having been around and solely dedicated since 2013. Really, our philosophy is genuinely investing in the long-term future of the digital assets industry and the secular tailwinds that we believe will continue. So for the liquid funds that I manage, that means the core of the strategy is really conducting deep fundamental research, finding investment opportunities in high quality businesses and protocols with good growth prospects, great management teams, and profitable unit economics, which of which we believe dYdX is one. So we're very happy to be here to discuss that.
Awesome. Thanks, everyone. Excited to have you here. So the dYdX chain has now been fully operational for a few weeks, and recently trading and fees were also enabled, which means dYdX is now officially sharing 100% of the trading fees with token stakers and validators, with no fees going to dYdX Trading Inc. Do you think this is a model that will continue to be the standard for decentralized exchanges, or how do you guys see that shaping up at the foundation?
Yeah, it's a really great question, and really one of the biggest fundamental changes with regard to token economics for the dYdX chain relative to what existed before on Ethereum. I think the past version of the protocol on Ethereum was an app chain on Ethereum using Starkware as a layer 2 and Ethereum as a settlement network. And as an application on Ethereum, you're subject to kind of the rules of the Ethereum ecosystem, which really are not, are very generalized for every single application out there. And so historically with, the perpetuals product V3 on Ethereum, there's been over $1 billion or over $1 trillion of volume and a lot of fees generated, which ultimately have been, invested and reinvested into the growth of the protocol and the development of the open source software. But despite having, token holders, 70,000 unique wallets earn dYdX tokens on Ethereum over the last 2.5 years, providing governance and utility rights over the Ethereum protocol. There was some misalignment when it comes to token economics and the alignment of different stakeholders. And so, with the launch of the dYdX chain and the dYdX community really adopting the dYdX chain as the next version of the protocol, and through governance, having the dYdX token be the main staking token within the dYdX chain. There's been a fundamental realignment between different stakeholders in the ecosystem. And so at this time on the dYdX chain, following a number of dYdX governance votes, all protocol fees generated by the protocol ultimately flow to validators and to stakers who in a proof of stake blockchain really contribute to the economic security of the chain, right? It's a fundamentally kind of different construct. And with a proof of stake blockchain that has been designed and optimized for the trading use case and the high velocity trading use case, you can really design an incentive system that really helps drive performance and better alignment between kind of various ecosystem partners. So, Yannick, the chain has been live for about 6 weeks, 2 months now, but really in full production since early last week. There was a 1 month, alpha and beta period, and then following a number of governance votes, the community has decided to activate trading rewards in a 6-month incentive program, and really we started to see volume and fees really pick up starting the early last week. I think to date the chain has already seen over $500 million in trading volume, with daily volumes reaching I think about 160 million yesterday, and over $100,000 in trading fees already generated by the protocol and passed on to validators and to stakers. I think there's about 30 million or so bonded tokens today, really helping to contribute to the economic security of the chain. And again, all of this is really uniquely enabled by the fact that this is a proof of stake blockchain where the economic security of the chain is determined by validators and stakers. So to answer your question directly, is this the future of DEXs? I think this is definitely the future of the dYdX chain and a key kind of value proposition relative to others out there. I think this is really uniquely enabled by the fact that the community made the decision to move from an application on Ethereum to a sovereign blockchain where that realignment of incentives between different stakeholders can really be customized in such a way that drives growth and security for the ecosystem at large. Ultimately, if other I suspect other DEXs that remain as an application on other L1s or really don't vertically integrate, it may be challenging for them to make kind of that leap. But I think our thesis at dYdX is that's the future of DEXs, and that's why we've as a community made that bold decision to move from an L2 to a sovereign app chain.
Gotcha. Yeah, that makes a lot of sense. And you already touched on a few things, that I wanted to cover with my second question around the whole, AppChain model compared to, being on an Ethereum L2. Maybe looking at this a little bit more through the community lens. I mean, you mentioned there's been governance votes already. Is this something where you guys also see a difference, and maybe something that doesn't work as well with an L2 chain, that you do have that community more engaged now and more aligned with the protocol, and that offers you more flexibility as well to just kind of engage with the core community? Because there's two parts to it, right? One is the users of the protocol, and then there's also the community itself, which is a lot more interested in maybe like the long-term the long-term success of the protocol. So would be keen to understand, and maybe Karen, there's something for you to answer, how this switch over to this AppChain model has maybe helped a little bit in terms of scalability of the protocol, but also scalability of the community almost.
Yeah, for sure. I think some of the points, as David mentioned, of course, AppChain enables this sovereign chain, and with its own validator set, with its own security, which moves away from a common security model. On the community scalability side, of course, with your own AppChain, there are much more parameters that the community can essentially define and vote on. And the biggest thing is the chain or the product becomes more and more decentralized. So what essentially this Cosmos, this new AppChain for dYdX, what it enables is the entire order book, entire matching engine is now run on this distributed validator network. And as I mentioned, like these validators participate in governance, and they control and like essentially like have authority on more parameters, more specific things that would help the protocol scale further. So yes, the dYdX chain, of course, brings in this element of growing with the community, giving them, empowering them more, and also like, offering the entire security of the chain in the hands of the community as well.
Got it. Yeah. I think so far, at least what we've seen, it's been quite a successful launch, and a long time coming too. We're multiple test nets and everything. And Pantera Capital has been an early investor in Cosmos as well. So with this recent launch, of dYdX, with this app chain, and then also native USDC recently, and rewards being paid out in USDC as well to stakers and validators. How do you guys see it over at Pantera Capital? Is Cosmos, the Cosmos ecosystem, finally getting its due? Is it finally ready to fully take off? Also on the more institutional side, would be keen to understand how you guys are seeing this play out currently.
Yeah, absolutely. I guess first I'm gonna, like, as you were saying that question, I'm gonna preface this by saying that whenever I talk about Cosmos, it's always a little weird because my name is Cosmo, but I promise I'm not referring to myself in the third person. But yeah, I mean, look, Cosmos is a really exciting blockchain architecture. It really highlights the power of modular blockchain ecosystems, and it's, as a result, it's been or continues to be and has been a hotbed for economic experimentation at the base layer. Because you have all these pieces that you can choose which to use, like really it allows builders to focus more on the tokenomics and like how to really optimize their app chain for their use case, as opposed to spending a ton of time on infra and hard tech, which only needs to be solved once. So Cosmos really enables creation of highly customizable blockchains, and it makes it easy to spin up a new chain. And so I expect to see a continued shift towards more specialized or app-specific blockchains because of this benefit of increased customizability and sort of this increased experimentation that it allows for. And I think that's why we've seen like a lot of new major chains launch on Cosmos, whether that's Injective or Say or Noble with USDC and most recently dYdX. And in dYdX's case, David and Karen would be able to speak to this better, but really they've leveraged the customizability of Cosmos to launch a new version that's, version 3 worked great, but version 4 is even better because it's even more decentralized, even more scalable, and really like gets you to their ultimate vision a lot faster. And so all that is really exciting. It's obviously very early, and blockchain systems are network businesses, so it requires momentum for the flywheel to get running. But we're starting to see that with a lot of major applications coming on board. And another one that you mentioned was sort of the addition of native USDC with Noble, which is, first of all, that wouldn't have been possible or really widely pushed without dYdX being the one to say, hey, we need USDC to make this work. And by the way, the Cosmos ecosystem makes inter-blockchain communication really easy through IBC, or they call it inter-blockchain communication protocol. And so that's really powerful, right? Another great protocol in the Cosmos ecosystem that we're invested in that leverages IBC to connect to dYdX is Stride, which is a liquid staking protocol, right? Think of it as Lido on Cosmos. It's gearing up to launch the liquid stake version of dYdX, stdYdX, which I think should help further increase security and decentralize the validator set on dYdX. So yeah, I think there's a lot of really exciting things going on in the Cosmos ecosystem. And
you're definitely Cosmos aligned with your name, so that's good.
Yeah, that's right. My dad is, that's for sure.
For sure, yeah. No, I think one of the things you touched on as well, customization. I think it is quite interesting to see that more and more projects are leveraging the Cosmos SDK, and these frameworks that have been built and adjusting them, to their liking and to their needs. And I think that's also a sign of a maturing ecosystem, that the tooling and everything is that good, that everyone kind of sees a winner there, and it's like this is the tooling that we will work with. One big concern for dYdX having their own chain was MEV, and MEV with the validator being on the order, with the order book being on the validator, being a concern of collusion there. We actually published a report there that went into quite a lot of detail. We got a grant from the dYdX Foundation to to look into this and to see what we can do to mitigate bad MEV and MEV in general. And so I think one question that I have there is if you think MEV will continue to play a major role in this ecosystem, and if you imagine or envision MEV would ultimately accrue to kind of the protocol itself on or how do you think this will shape out? Because dYdX has been very focused on making sure that with this new chain there isn't collusion, there isn't any bad players that can get away with it, so to say. So we'd be keen to understand how you guys are thinking about this now.
Yeah, that's a great question. Maybe just to level set for the audience on kind of what MEV is. MEV is maximal extractable value. It arises when a particular block producer changes the transaction inclusion in order to benefit kind of themselves. MEV is quite common in other L1s, and there's a lot of academic and other research on A, how to define MEV, and then B, how to measure and track, call it bad MEV versus good MEV. I think MEV in particular, for a trading kind of application chain, transaction reordering MEV is obviously really bad. MEV from censorship or arbitrary inclusion is equally as bad. I think the way to think about it is MEV is for the most part bad. There's maybe some MEV that isn't as bad or that would be viewed in other types of market as just arbitrage. But as a general principle, trying to prevent MEV and having an MEV strategy is really important for the end user experience as a whole. And in some ways, the dYdX chain today is kind of in the very early iterations of trying to address MEV at scale, right? But ultimately, any mitigation strategy is really trying to prevent bad MEV, which ultimately harms liquidity, harms users, harms price formation. And so, what is the best way to address MEV, and what has the dYdX chain and community done so far? So, I think as a step one, as a community, there's been a lot of research published, including the research report from Chorus One, and then really active debates on our forums around how to even define MEV. And there's been multiple blog posts about that. And then in addition to that, the Skip protocol team has published kind of a dashboard for the community to look at with methodology that tries to look at each validator and try to actually assign a dollar value to whether a given validator is engaging in bad MEV. I think that's really kind of the starting point. It's A, agreeing on a definition, and then B, agreeing on a methodology as a community to at least understand behavior and try to come up with kind of novel mitigation solutions. I think as a step one, earlier this week, the governance community on the dYdX chain formally adopted a proposal to launch effectively a social mitigation strategy, where the community has empowered a committee of external researchers to effectively look at the Skip protocol MEV dashboard, look at potential incidents of MEV, and then recommend to the community the potential for social slashing of a validator that participates in negative MEV. And so that's, I think really the approach in the short term as the chain launches and ramps up. There's really kind of a very credible threat of social slashing that should discourage validators from participating in extractive value. I think it will be interesting to see how that process develops. Again, I think social slashing in other Cosmos-based chains have been quite controversial. This is probably one of the first examples of the community really empowering a committee to make recommendations based on expert recommendations to the community on social slashing, which should hopefully alleviate some concerns around misaligned interests. But I think that's really kind of the approach that the community has decided to take, in this first stage of the chain. Ultimately, I don't think this is like a perfect solution, right? At some point, as we get more empirical data, as we get lessons learned, as we understand how the system works as it scales, I think I'm excited to see kind of what new solutions the community comes up with. Ultimately, you've seen other case studies across the board around internalizing MEV at the protocol level. Can you automate some of these rules at the protocol level? I think all of those are great ideas. I just think it's going to take a little time to really get empirical data to make informed decisions on what that could look like. But ultimately, the general principle is, trying to get as much of these rules enforced at the protocol level, creates kind of reduces uncertainty across the board and just creates kind of the same playing field for all participants. And so, I hope the community kind of moves in that direction, but I think it's going to take a lot longer based on kind of where we are today.
Yeah, so it's a bit more of an iterative approach, it seems. And if I look at previous social slashing events that happened in Cosmos, I think a lot of these happened when there was something very unforeseen, and then there was a lot of discussion there. But yeah, I think having already looked at the topic of MEV for a very long time before the chain launches has made this a lot easier for the community as well, because there's already a lot less unknowns about this topic, and there's already more of a maybe framework or at least mental model on how to go about this. But yeah, I would be keen to understand Pantera Capital's broad view on MEV and its future, and how you guys are seeing this.
Yeah, sure. I mean, look, I want to echo a lot of David's thoughts, which are that it's important to separate out toxic MEV like sandwich attacks or censorship versus non-toxic MEV. There are plenty of examples of MEV that doesn't adversely impact transaction inclusion or effective price and is actually beneficial to the consumer. I think for those who are less familiar with blockchain, I think of MEV. It's not a perfect analogy, but I think of MEV as analogous to payment for order flow in retail brokerages. Basically the primary source of revenue for any retail brokerage today is payment for order flow, which is analogous to MEV. It's basically the value from the information of the order flow that the market maker is willing to pay. That has proven to accrue a lot of value to consumers or users of retail brokerages over time. Sort of to continue that analogy, I believe that the Blockspace model will evolve in a very similar way. Access and competition grew. Brokerages had to lower per trade commissions from their $20 only 20 years ago to $10 only 10 years ago to $0 today. And the analogy to crypto would be gas fees, right? Like right now you have to pay validators for gas fees. And I would expect a lot of those to be to go down over time. And eventually that benefit obviously of lower transaction fees accrues to the user of the blockchain. And today brokerages primarily monetize retail traders through payment for order flow, and I would expect in the future that validators in the future in crypto primarily monetize their users through MEV. And so without payment for order flow, retail brokerages wouldn't be able to offer commission-free trading. Without MEV, users on the blockchain wouldn't be able to have as good execution, as good price certainty, and potentially lower gas fees. And so it's important to realize that yes, MEV is by definition, there exists some economic surplus in the system that needs to be divided somehow, and someone's going to go and find it. But the beauty of a well-designed MEV architecture, which is what we're trying to do on dYdX, is that value is split between three parties, right? It's split between the searcher or the market maker. It's split between the user and then the protocol itself. And if you kind of find a good balance where there's a win-win-win, that's the best case scenario. But there's no doubt in my mind that MEV is part and parcel to blockchain systems, so it's not going away. And I think it's incumbent upon us to do the good work of properly extracting non-toxic MEV and allocating it fairly amongst the different parties.
Yeah, so being very proactive and figuring out the best system and the best system going forward. No, that's quite interesting. And if we go look at the kind of staking economy, us as validators on dYdX, we are trying to be credibly neutral. Try to just run a good validator. You guys work with a lot of validators as well, and different node operators. What type of factors do you usually consider when looking at node operations and staking to a node operator from Pantera Capital?
Yeah, definitely. I mean, look, I think staking is super important for securing the value to a system, and ultimately, as a fundamental investor, I care deeply about value accrual, and so this is one of the main ways protocols will return validated token holders. For providing security, you earn a yield on that work that you're doing, or for that token that you're providing, and so I think it's really important. When we're choosing a service provider, then our considerations are really about quality, right? Or I guess they're a fewfold. The first category of considerations I'd say is just we want to be responsible stakeholders, and we care about ecosystem health. So we care about decentralization. We care about a validator's contribution to governance and product development. And then secondly, we are fiduciaries to our LPs. So, we have to do things that are the best financial decision for our limited partners. And so that means that we care a ton about security, performance, fees, and service quality. I'd say if you bundle that all up, look, we are supporters of Chorus One and users of Chorus One staking service. We think they're a great example of high quality service provider from that ecosystem health or stakeholder perspective. Look, you guys are Chorus One has done a ton of great work around MEV papers, this webinar that they're hosting, and then on the being fiduciaries to our LPs. Clearly the service levels are there, and the security is there, and the performance is there, and so we've been that's really what we're focused on, and we think Chorus One has been a great partner in helping deliver that.
I mean, sorry, go ahead, David.
Yeah, totally agree with everything Cosmo said. Maybe just to add a few data points there. The active set in the dYdX chain has 60 validators, and I think there's over 140 or so, 145 nodes currently competing to be part of the active set. Running a validator is fully permissionless, and so there are great validators, and then there are less good validators, and ultimately, it's really incumbent on stakers to really do their diligence on different validators. Small plug, the dYdX Foundation did publish a blog post, maybe 2 months ago now, with just a broad framework for dYdX chain validators to consider kind of best practices or good practices, and then for stakers to consider before staking. Some of the metrics that we think are important to highlight and for stakers to consider, are things like, the MEV is a validator actually doing toxic MEV and really using that as a factor in their decision making. Ultimately looking at the performance of validators, uptime, the risk of getting slashed for double signing or for bad uptime, things like operations and security, things like governance participation, things like transparency, and other kind of broader ecosystem considerations. So the general TLDR here is validators are core stakeholders on the dYdX chain and any proof of stake blockchain. They run really important infrastructure, and as a result of that, they get a commission for running that infrastructure. But for stakers out there, really doing your diligence on who to stake to is important. I think bonding tokens is quite sticky, but really making sure that you're picking the right validator, that you're holding that validator accountable, and then you're redelegating kind of your stake for whatever reason. If the validator is underperforming or you're trying to optimize for a certain value, ultimately that responsibility sits with the staker, and it's important for them to continue to do their diligence more broadly.
Yeah, I agree. I always tend to think of validators as kind of professional community members, right? We have a lot of experience running multiple chains, multiple chains across different ecosystems. So we've seen a lot of best practices, but also a lot of things that don't go well. And so as both of you mentioned, there's a level of just running a good operation, running securely. And minimizing any risk that you have there. But then on top of that, I think it's a lot about contributions to the ecosystem, and with the Cosmos SDK having governance baked in, and delegators in a lot of cases trusting their validators as well to vote on their behalf, even though they can always override this. I think it does come down a lot to how have these validators been in the ecosystems, how have they participated, and you see a lot of divergence as well, and there's always a lot of interesting discussions around Cosmos as an ecosystem. Everyone knows there's interesting forums and interesting snapshot votes every other week, and so staying on top of these trends and being a good custodian as well of the ecosystem and a good stakeholder, I think is super important. And when it comes to the kind of operational setup, we want to talk a little bit about institutional interest as well. And this has been, at least it feels a little bit like it has been picking up, with multiple large players submitting ETF applications. And it's a bit of a meme that institutions are coming to crypto. It's been sad over the years, but it does feel like there's a bit more momentum now. And since both of you are working with institutions and investors as well, what's your feeling this time? Are the institutions actually coming, or is it just like the slowly evolving a meme that that's been running for a while? And maybe Cosmo, you can answer this first.
Yeah, sure. I think at a high level, I do believe the institutions are coming. I don't think myself or many of my colleagues or the people on this call would be spending the enormous amount of effort and time in the space if that wasn't true. If this remains sort of a retail playground, it's not interesting as a TAM. But I clearly don't believe that's true, and that's why I'm here. There's a lot of evidence of that. I'm a consumer internet investor by training, and so I see the announcements from all of my prior covered universe, from the Facebooks to the Activisions to the Spotify's of the world, everyone talking about their Web2 or their Web3 strategy. And then you do look at the payments guys and the financial institutions. Yeah, there's tons of adoption, right? Like Visa or MoneyGram, like all of these payment companies have really leveled up their integration with blockchain services over the last few years, despite all the negative headlines. And then very significantly, I would say that the ETF applications, which are pending and seemingly very likely to happen in January, if they do happen, I think it's really important or very significant. And there are a lot of reasons, but maybe just keep it very simple, I'll talk about the two most important ones. The first is really access, right? I think the ETF really increases access and demand for the asset class faster than most anticipate. Many financial advisors are limited to allocating to U.S. exchange traded products through traditional channels. They can't go on Coinbase. They can't they can't go into hedge funds or closed-end products like GBTC. And so they are, by creating an ETF, it massively increases access for the vast majority of people who actually could not access crypto, which is maybe surprising to people on this call, but shouldn't be. And so that's access. And second is really signaling, right? This really signals to investors, to people at large, that crypto is a legitimate asset class with a durable future. Many people are curious about crypto, but pretty scared of crypto intermediaries, and seemingly for the right reason over the last year. But FTX is being replaced with BlackRock and Fidelity. And an ETF approval also implies regulatory acceptance. Another one of the most frequent sort of pushbacks I get from LPs and others not in the system. But they can't launch an ETF without having gotten the regulatory nod. And all this will really result in social acceptance, which is Bitcoin and crypto at large is acceptance as an asset class. I'm getting tons of calls from the biggest PMs at the largest macro funds like Blue Crest and Millennium, all talking about how Bitcoin is once again piquing their interest. So it's not just the service providers like the JP Morgans and Fidelity of the world. It's actually the capital allocators. So all this is very exciting, and I do think this is like a good potential start, or we're starting to see some real green shoots for institutional adoption.
Yeah, I agree with all of that. I think for DeFi and DEXs, I don't know how impactful an ETF will really be to kind of the success of decentralized protocols, but certainly it increases interest. It increases, call it the top of funnel of fiat to crypto, which is kind of the first step. For a protocol like dYdX, we get a lot of questions around institutional adoption of a DEX. I think one thing that makes dYdX unique relative to other DEXs out there is really the exclusive focus, at least for now, on a central limit order book as really the main liquidity model for the exchange. Compared to other kind of AMM type DEXs out there, generally speaking, dYdX is really focused on the institutional and prosumer segments. And if institutions are going to make a leap into DeFi and DEX land, typically, dYdX is probably the first DEX that they integrate with. Given kind of the extensive APIs, the low latency, the high throughput that the dYdX chain enables, it's a really easy kind of next step for a market maker or an institution who's used to trading on a centralized exchange to really kind of make that leap into DeFi. Sure, there's kind of new complexities around self-custody, but the institutional infrastructure to be able to support self-custody has gotten a lot better. And frankly, we've seen a lot of partnerships, integrations, tooling specifically around the dYdX chain that have really unlocked kind of the institutional use case to make that onboarding and custody experience up to the standards of institutional players. So net agree with everything Cosmo said, but I think institutions making the leap to DeFi and DEXs will probably take longer, but I do think a lot of the infrastructure is now in place to be able to support that as more flows move from fiat to crypto, and then ultimately, from centralized exchanges to DEXs.
Yeah, and just to quickly dovetail on that, I do think that everyone has fiat, so they need to onboard onto centralized exchanges first, or centralized counterparties first. But I think what is exciting is that as more capital comes into the space, there's more willingness to experiment and actually use blockchain for its real purposes. And so to David's point, that's when we'll start to see real flows come back into DeFi and come back into using DEXs. And a big reason why institutions don't use dYdX or don't use DEXs in general, or as much as they should, is really part of a lot of it's like just social acceptance and regulatory acceptance. And that's why I think that last point I made about the ETF really signaling legitimacy to this asset class starts to alleviate some of those concerns and can really be that bridge to using DeFi a lot more.
And is that something you see in Asia as well, Karan? Because we talk a lot about the BlackRocks of this world, and the news, especially on the institutional regulatory side, being very much US focused. But in a lot of ways, the Asian countries have accepted, and also the population in Asia, it feels in a lot of ways have accepted cryptocurrency faster then I mean, I'm from Europe. We're generally the last to accept any new trend. But yeah, would be keen to see to hear your take on this as well. If these trends also present in Asia currently.
Yeah, I think one of the trends that we have been observing in the past is Asia usually like follows or looks at some of the regulatory developments that happen in the West. And like at least in the markets that I'm looking at, there has always been a discussion around how regulatory bodies are looking at ETF and how that would open like retail coming in more. So I think Asia market have like a big retail volume. And once there's like more clarity on ETS, once there is like more availability of these options for retail traders, I think there would be, of course, like more Asian regulators looking at offering or thinking around like options for how this could be like brought more for retail. I think one of the interesting things is recently we have been doing a research on comparing like how traditional financial institutes operate and how that compares to DeFi. And some of the findings are around ETF, and as David mentioned, there would be, if there are like these shares more available, and if there are like decentralized products looking at integrating, I think dYdX would be, of course, in the forefront and would be following some of the latest development. And like I'm sure the community would be thinking around ideas how they can bring this forward. And then, of course, it would open not just Asia, but also like other markets for the protocol overall.
Super interesting. I think we're already, getting, short on time. So maybe to wrap this up, be keen to hear your take, Cosmo, on, what sectors in crypto currently excite you the most. And then maybe after you've from the foundation side, what's coming for dYdX, what's in the future, what's in the works, and we can kind of wrap it up with that.
Yeah, for sure. Look, as fundamental value-focused investors, I'm most interested in areas where there's product market fit and large growth potential and profitable unit economics. I think two areas really stand out today. That's Blockspace, so L1s, L2s, and two is trading, which is where dYdX falls in. The most frequently used blockchain apps today relate to trading, and trading is a very core human activity that's been around for millennia with inevitable demand. So I don't expect that to ever disappear. So that's a great business to be in. And I think dYdX is a great example of a protocol with attractive fundamentals at a reasonable valuation within that subsector, right? It's the market share leader with 60-ish% share of a category that's taking share. And that's perpetual DEXs taking share from centralized exchanges. dYdX has experienced an inflection of profitable unit economics this year as it's lowered its token emissions. And importantly, which David mentioned at the very beginning of this call, is that for token holders, there's also a meaningful inflection in capital allocation, with capital return officially beginning with the V4 upgrade. And so, you're talking, call it double-digit staking yields now. And what I've always seen is that businesses always see very powerful moments of appreciation when they reach an inflection in profitability and capital allocation. And in this case, there's both. So I'm very bullish on Blockspace and trading in general, and also I think dYdX specifically as having a really great growth trajectory within that category.
Yeah, I think in terms of the dYdX chain and what to kind of expect over the next few kind of months, so the dYdX chain officially launched, 6 weeks ago. There was 1 month of alpha and beta, and then subject to a number of governance votes. The chain is in full production mode as of Monday last week, and so really the focus for the community at large is growing and scaling the dYdX chain in a progressive manner. I don't think there's in other industries or even in crypto, you launch a new product and then there's kind of 100% adoption day one. I think this is going to be kind of a more progressive approach where you need to increase security of the blockchain through increasing the amount of tokens that are bridged and staked to validators, and that's a key input to then drive more liquidity on the platform and more USDC collateral via Noble. And ultimately that drives, the volume flywheel and the fees flywheel. And so you need a lot of these different components to really grow in tandem. And we're still in that very early stage of, growing a multi-sided marketplace through kind of the DAO and the community at large. So, the way that I think about kind of the next month is really around helping really the user base understand the dYdX chain, testing out the chain and the product experience for the first time, and really getting a lot of the fundamentals in place, key integrations, key partnerships that really unlock the onboarding and user experience as a whole. So that's really the focus for the first month. I think the following 6 months, I think the dYdX chain today is great. It's certainly on par, if not better, than the V3 protocol. But I would still call it an MVP. There's definitely a lot of additional enhancements that could be made now that the infrastructure is in place, and really moving from MVP to a world-class product is really the goal for the next 6 months after that. Ultimately, today I think there's like 30-ish markets that are available on the exchange. I think one thing that is going to be uniquely enabled by the dYdX chain is really this ability to trade anything and to really rapidly increase the amount of markets on the exchange based on where there's demand. And so really getting to a place where there's permissionless listings, several hundred markets, a really fast listing process based on the dYdX governance community. I think those are really massive unlocks for the user base to really trade, whatever people want to trade with in a safe and secure and transparent manner. So I think that's really what to expect for, call it like the next 6 to 12 months. It's continuing to unlock and grow and scale the protocol and create that growth flywheel across the board.
Exciting. Maybe we even see some more price discovery on decentralized exchanges and not only the centralized ones. Quite exciting times ahead. This has been super insightful. I don't know, Karen, if you want to add anything to it.
Yep, I was just going to add a bit to what David has said. So a major focus for us would also be to educate like different user base, different stakeholders, understanding that most of the user base would be coming from Ethereum. Some of the community members who have like experience more on governance of Ethereum, how they can participate, like stake their tokens, how they can like participate in Cosmos governance, and also for any builders or partners that want to integrate with the product, how they can run different software for dYdX or infrastructure or running a validator. So I think a lot of focus would go into that education and essentially communicating all these like concepts with the community, right? So that's going to be another major focus in the short term and medium term.
Yeah, maybe one more just thing to add. Just really excited to really bootstrap an ecosystem around the dYdX chain. Obviously, Cosmos infrastructure is a little different than Ethereum. The dYdX chain is fully open sourced, from A to Z. It really creates a whole new design space for really any developers, builders, any ecosystem partner to really come in and help drive the protocol forward. And so I think really building out that ecosystem and helping to grow the pie for everyone is really a focus for the protocol at large.
Amazing. Awesome. Yeah, then let's wrap it up. Thanks so much to all of you for taking the time and sharing all these insights. It's been super interesting. And yeah, if anyone has any further questions, I think they can always reach out to the different parties here. And we're always happy to help. And yeah, as you mentioned, education, I think is one thing as well, across the board, across the ecosystems that we still have a lot to do of. So thanks all for joining us.
Thanks a lot, everyone.
Thanks a lot.
Thanks for hosting. Bye.
Thanks.
Bye.